Okay, the title of this video is Why You Should Never Put All of Your Money into an Annuity. And I actually want to look at this from two tangents. One is from a suitability standpoint, but just to be fair, as you can tell from all the videos we do, that we're trying to educate, we try to keep it middle of the road and look at both sides of every situation. I also want to talk about the perception that annuities and insurance agents have in the industry, and I'll call this perception the hammer and nail, meaning if you're a hammer, then everything you see through your glasses is a nail. So suitability. There have been dramatic changes in the industry, specifically from the insurance companies when it comes to suitability, because obviously there are agents that have made a mistake where maybe the only thing they could sell is an annuity, and they would look at a person's portfolio, and the person had stocks and bonds and real estate and mutual funds and index funds and so forth, and a particular agent wasn't able to help them with all that, so they just simply said, you know what, you need to take a bulk of all this money or all of it and just move it into an annuity, and basically convince them that the reason they're doing that is because of risk. And I believe if a person has a very low tolerance for risk, that annuity certainly plays a role in that, because after all, that's what an insurance company does. If you own a home and it's struck by lightning and burns down, that's a risk. And that's why people have State Farm or Allstate or whatever your favorite homeowner insurance is, because if that happens to you, you want State Farm to be able to pick up the bill and rebuild your house for the small amount of premiums that you were paying to them each month, right? Look, the same thing happens with your life and your health and your car and so forth and so on. That's what an insurance company is in the business to do, is to manage risk. And for some people, there is risk inherent in their portfolio. Up here, there's risk inherent in their portfolio, or they have an income, specifically a retirement income risk, and an insurance company can address that by the design of an annuity. So I think there's obviously clear applications for how an annuity works in a person's portfolio, but what I want to show you is the length that the insurance industry has gone to. Okay, so here's a typical application. I want to make sure that there's no company information on here. I want to make this as generic as possible. So this is a client financial disclosure form. As you can see, there's an acronym right here, CFD, Client Disclosure Financial Disclosure Form. So let's look at the type of questions that they're asking here. So financial status, what's your monthly income? Will the purchase of this annuity reduce your monthly spendable income? Do you anticipate any decrease in your monthly spending income? So in other words, these first three questions are getting to, okay, if somebody invests in this annuity, is it going to create some kind of financial hardship on cash flow? So they want to find out about that. Taxes, that's an obvious one they want to be able to cover. Number 6, approximate household net worth. They want to know what your net worth is other than your home, other than your primary residence. And they have some boxes you can check on the amounts here. What's your investment experience? Are you new to investing, or are you very experienced in doing this for a while? What's your risk tolerance? Are you looking for growth, or are you looking to monitor your risk and make sure you have lower risk? If you own your home, and what other investment portfolio do you have? What are the amounts? If you have other things like bonds and CDs and savings down here, if you have these other things, what percentage do you have of there? So let's scroll down here a little bit more. How much do you have in cash, savings, money markets? Is any retirement plans, life insurance? What's the health of the owner, and what's the health of the spouse? In this next section, they want to know what the total purchase payment, how much money you're actually putting in the annuity. And notice here in the bold it says all sales $250,000 or more must complete and submit a financial inventory worksheet. So a big chunk of money, they want to know everything else that's going on. This gets back to what I was saying earlier in the whiteboard portion, that somebody has an entire portfolio that they're not taking every investment they have and plowing it all into an annuity. Number two here, purchase payment as a percentage of your net worth. Again, if it's 51% or over, here's the different percentages here, you have to fill out this financial worksheet. Before we go into what the worksheet looks like, let's continue on because we're still not through with this portion of the application. Okay, question 3 of section B, what percentage of your total investment portfolio is the potential annuity purchase? Again, over 51, they want to know that. And then number 4, value of all annuities owned. They want to know if you already have annuities. Here is your financial objectives and considerations. What's the annuity going to be used for? Do you have sufficient cash available? They already asked that in the other section, but they want to know again. What other financial products do you currently own? Do you already own annuities? And again, this is going to be covered by that worksheet we're going to look at in a second. So if a person is putting, let's say, $50,000 in, then these questions here would be germane because you're not having to fill out that other worksheet. But again, some of the questions they're interested in about what other products you have, because they're looking at percentages. Do you have too much money in annuities? That's why they want to know the answers to these questions right here. Question number 5, what is the source of this annuity purchase payment? Where is the money coming from? Is it coming from another annuity? Is it coming from a CD? Is it coming from stocks, bonds, mutual funds, and so forth? And then are there any fees, penalties, surrender charges, or other costs associated with the source of these funds? In other words, this money's coming in here. Are you having to pay some kind of penalty to get it in there? Let's go to section D here, accessing your money. And section E would be replacement. So I'm going to stop the scroll right here because below this line down here shows the insurance company name. And again, I want to keep this generic. Section D, accessing your money. How do you anticipate taking distributions from this annuity? So they want to know if you want to turn the income on, how you're going to do that. When do you anticipate taking your first distribution? They want to know, is this going to be less than a year, 1 to 5 years, 5 to 9, 10 plus? Replacement. Have you ever exchanged or replaced an annuity? Yes or no? If no, then you check that box. Yes, within the last 5 years or more than 5 years. They want to know if an insurance agent is moving someone from one annuity to another in order just to generate a commission. And if that's the case, then some of these other questions are going to ferret that out. They're going to be able to give you some information, give the insurance company information to make sure that there's not some inappropriate switching going on at this point. Okay, now let's switch to that inventory worksheet we were talking about. Again, as you can see here, if it's an IRA or if it's non-qualified money over $250,000, this is a required worksheet. But you notice here, may be requested for IRA non-qualified sales lower than $250,000. So there may be times when they filled out the application and some of the questions were answered. It sent the radar up with the insurance company, and let's say the person's just putting in $75,000. They may not have liked some of the answers to those questions, and they will require this financial inventory worksheet, even if it's a lower purchase like $75,000, just so they can see what's going on. Again, they want to look at overall your income, what your expenses are. They don't want somebody putting money into an annuity and it's all their investable assets, and then the next month they're struggling to make their mortgage. That's not a smart thing. The other portion of this worksheet goes into net worth, different investment status over here. What are you investing in? And then what is your debt? And then you come down here, you total everything up, and there's a spot for the client name and your signature. So the reason I wanted to show you all this is because I think it's important for you to know that the insurance companies are very aware of what's going on with this concept that there are insurance agents out there putting all of an investor's money into an annuity. Now, let's go on the other side of the coin here, and that's the old hammer versus nail, in that if an insurance agent, all they can sell is an annuity, then everything looks like a nail to them, meaning every person they meet and talk to, they're going to try to put their money into an annuity. And this whole perception, unfortunately, comes from a few of the bad eggs that didn't do the appropriate suitability, but also this perception comes from financial advisors, investment people that don't sell annuities. They don't sell annuities because of whatever bias they have from things we've already discussed, or they believe that the way they go about investing, how they design a portfolio, how they manage money is superior, and so they're just going to look down their nose at annuities and say they're bad or they're expensive or they don't have an appropriate place or whatever. But I will tell you that if the average financial advisor has a client that is low risk and income oriented, low risk and income oriented, I'm sorry, in this interest rate environment with the 10-year treasury, the 10-year treasury closing at around 2.6% today, I'm sorry, you know what? That's not generating a lot of income for a retiree. And a sophisticated financial advisor should be looking at, well, what can an insurance company do as far as managing risk and providing income, retirement income for a client? I just think it's actually taken the argument too far on this whole hammer versus nail and thinking that there's no place, there's no reason for an annuity for the average investor. After all, in 2012, $34 billion went into index annuities alone. That's just index annuities, which if you watch any of my other videos, you know I'm a big fan of index annuities because it operates on the chassis of buying an option that gives you some upside when the market does well, but you have zero downside if the market does poorly. But anyway, we have plenty of videos that go into all that and explain that. So I hope that's fair with you. As you know, in our Annuities for Education, we like to do both sides of the equation to keep it fair and balanced, as seems to be the popular phraseology these days. So anyway, thanks for watching.